On today's program, sluggish growth in America and China, yet every topping bell indicator is ringing in the overvalued U.S. stock market. How many times do we have to see these signs repeated, 1987, 99, 2007, to get out of the market in time?
The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
Again, count it all together. You've got $500 billion in borrowed money, margin money. Then you've got $200 to $400 billion in volatility-sensitive, professionally managed assets, which trades exactly like the portfolio insurance models of 1987, right? So selling begets selling begets selling, and that is what your safety is based on, is getting out of the way of the market.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. It's interesting, Dave. Over the last few years, we've seen flight capital coming out of countries. You know, I think of Cyprus or I think of Greece, when it looked like money was going to be trapped in a system, and it flowed to two major places. One was gold, when it could be had.
And typically the other was treasuries, although to a lesser degree in terms of total volume. You also saw some interest in things like your cryptocurrencies.
Right. Well, and the thing is, Bitcoin soared during the Cyprus thing. Okay, if you recall, that was a couple of years ago. Gold was also being purchased at that time. Now, we're seeing something fascinating right now. We're seeing Bitcoin absolutely going parabolic. Just the last few days, last few weeks. And gold is seeing strange, short types of activity. In other words, in low volume periods of time, you'll all of a sudden see 20,000 contracts of paper gold shorted on the market. It's just fascinating to see that maybe there's something going on. You've got flight capital possibly going into Bitcoin, and you've got someone, I'm not going to name who it is, wanting gold to continue to stay down.
Well, and particularly that traffic on Bitcoin, it's interesting because on the consumer level, Chinese and Japanese investors have taken much more of an interest in it of late. And you look at the financial system in Japan. Is it fixed? No. Do we still have a 6 trillion yen commitment to buy ETFs and stocks on an annual basis by the Bank of Japan? Yes. So what do you have there? You've got this mirage of reality. You've got this false sense of security within the Japanese stock market because of the extraordinarily large footprint of the Japanese central bank. We have different versions of that in different parts of the world, but in Asia, you've seen more intervention of late and sort of controlling of the levers, trying to get the market to go a certain direction, and it's having an effect. Meanwhile, here in the United States, and I quote Bill King, he says, once again, the evidence is clear that the stock market has degenerated into a gauge of hope and hype, as well as abject speculation that's detached from reality. Masters of the universe is what he asks. He says, no, it's more like monsters of the universe.
Well, actually, I did go to see Masters of the Universe, the second movie. It's a lot of fun. I'm not a Marvel comic fan, to be honest with you, but, it would keep you laughing. But the Masters of the Universe that I'm talking about that do control the levers, Dave, are the central bankers. And there's this assumption that the central bankers are in such control at this point that a stock market really can't go down, even though it's as overvalued as it's ever been since 87, 99, 2007. Do you think they really are in mastery control at this point?
Well, they have to be to some degree because you continue to look at sales numbers for corporations, and those are not exactly impressive. You look at tax receipts at the state level, and there are very discouraging signs in terms of economic activity.
Right, there's a slowdown. Look at the GDP figures.
We had a great time talking with Kamran Bakari last week about everything Middle East, and did not have time to talk about the GDP figures, which were out the week before. And those are worth some note because the soft patch is being described by the Fed this way, and this is again in response to the GDP figures. He says the committee views the slowing in growth during the first quarter as likely to be transitory.
How many times have we heard the word transitory, Dave, in the last 5 or 6 years?
It's one of their favorite words. Yeah. We certainly hear it often enough. But here are some of the highlights. As we were talking, again, Turkey and everything Middle East last week, we didn't cover the highlights of the report. And we had the worst consumption decline since 2009.
Right.
So consumer spending, not particularly attractive. Inventories increased by $10.3 billion.
Right. And we've talked about that. When inventories are increasing, that's because people aren't buying.
Right. So there is this relation between bloating inventories and sales.
Right.
And lo and behold, the price to sales for the S&P 500, it's at new highs.
So what you mean is the S&P 500 is overpriced relative to the amount of sales. That's the ratio you're looking at.
Right. And I should say, while the S&P index is at new highs, the price to sales ratio with the S&P is within a stone's throw of its all-time highs.
That was back in 2007, wasn't it?
Actually, the year 2000, and we're already far, far above the 2007, 2008 timeframe.
So we've passed the warning sign on that.
That's right. So again, maybe sales are not a requirement in the new economy.
Well, you remember Richard Duncan, when we have him on, he says, well, you can just make up those decreases with government spending.
Right, but we did not see that in the last quarter. We actually saw government spending decline by 1.7%. So again, if you've got a decrease in consumer activity, if you've got a decrease in government spending, you're leaning pretty heavily on the corporate sector to make up the difference. And lo and behold, they didn't, which is why we ended up with a pretty punk GDP number.
It wasn't all down, though.
Residential investment was okay. So if you're talking about housing, residential investment improved nearly 14%.
Right. And I know we're drilling more with oil.
And of course, the bright spot there with real estate was attributable to good weather. But right, oil drilling, that's another source of investment, which was on the rise. It's another bright spot in the GDP report.
Well, and speaking of the Middle East, I mean, that's what's hurting the Middle East and Russia right now is because we are drilling more.
It's true. The greater efficiencies gained in the shale drilling, we're now producing 9.3 million barrels a day. When you throw in Libyan production in various sundry sources in the Middle East that are trickling in that don't really play ball with OPEC, it makes OPEC's cuts from last year very muted. And of course, prices are dropping again. So you've got crude, which is down pretty significantly here in recent weeks, actually the commodity that's been pummeled the most. And, yes, it's edging lower because you've got supplies, which are very elevated. But more on commodities in just a minute. I think it's worth noting that there are numerous tensions in the Middle East which are being glossed over at this point.
Well, yeah, what Kamran Bakari was talking about last week, it's just not being priced into the markets right now.
And it's why we spent a little bit of time talking about it, because what is not in view for the market is usually what takes you by surprise and what represents shock. So I can appreciate, why are we talking about the Middle East? It's not on anyone's mind.
Right.
Well, that's right. It's not on anyone's mind. That's why we're talking about it.
Right.
Because again, it's those things that surprise you that can often be damaging to one's portfolio.
Well, and historically, Dave, when you've got stock markets that are hitting all-time highs and financial mania is going on at the same time that the economy is slowing. I mean, I think the economy, the GDP for the first quarter puts us in at less than 1%. I think it's 0.7%.
That's right. So the U.S. economy grew at the slowest pace in 3 years.
Okay.
And this is the case that we're making for sort of brave moves higher in the stock market, is that it's supported by a broad-based economic recovery.
Well, and this is why I think you're carefully approaching a short fund at this point and recommending people who need to hedge their stock portfolio at least look at the short side while we're hitting these highs.
That's right. We actively manage a short exposure with Doug Noland. And I found it very interesting, Kevin, that in talking with a number of institutional asset managers about what we do and what we can do for them, along with high net worth individuals, there's a professional asset manager, probably, I don't know, age 45.
Okay.
I mean, certainly low to mid 40s. And his response was this: we don't need anything like that. It's not like Armageddon is around the corner. And it was interesting because there's the view of the seasoned investor who's been through multiple market cycles,
right,
has a few more gray hairs, a few more years behind them. And their response to our offering is so different.
Right.
It's been very receptive there. Big interest. But it's curious because it reminds me of the kind of conversations I had when I started at Morgan Stanley back in the year 2000. It was before any real significant price declines had occurred in tech.
It had been 13 years since a stock market crash.
There was a generation that had never seen a decline of more than 10 or 20%. And any time it happened, it was very short-term in nature. And it always lacked that quality of sort of a corporate Darwinian event.
Right.
See, the extinction's not in question here.
Well, we have the masters of the universe now, Dave.
And that's the ingrained belief that central bankers can, in the modern era, 21st century somehow control the downside. They're tools in the toolbox, which today have changed the investment landscape, or so it's believed. And it's interesting because, again, we get this feedback from experienced investors, whether it's private or professional, and they recall earlier iterations of the same sort of enthusiastic justification. And there still are doubts about central bank alchemy and the events that follow.
Well, and, I think we should probably look at things in a more broad way. When we talk about the stock market, we're not talking about all stocks. A big part of what's going on in the stock market really just boils down to just a few stocks. I mean, Facebook, Apple, Netflix, Google, Amazon. We're looking at a very small number of stocks representing what percentage of the stock market right now.
Right. So, with the theme of index buying.
Right.
And index is now representing better part of 25% of the total stock market, where people are buying ETFs. And that's a huge change in the market in recent years.
Right. They're not picking stocks. They're just picking an index of stocks.
Because they feel they needed exposure to a certain sector or what have you.
Right.
And what that does is it concentrates buying in the biggest names within those indexes.
Right.
So there's a disproportionate amount of buying that's done because the index is weighted a certain way, and it's not buying on the basis of a thoughtful discretionary process where a professional is looking at the business prospects, looking at the balance sheet, weighing liabilities, and determining whether the management of that particular company is going to drive future growth. Again, it's a disproportionate volume into companies just because of their position in the index.
Well, and right now, the Beanie Baby of the realm. Remember Beanie Babies? They were the hottest thing, and then they weren't. But the Beanie Baby of the realm is the acronym FANG. Which is that Facebook, Amazon, Netflix, Google.
Yeah, and we've seen it in every age. We've got your Nifty 50s, we've got your dogs of the Dow, you've got a variety of things which become popular themes that you invest in.
Right.
And these themes kind of define a generation's view of where you should be putting money. The FANGs, of course, Facebook, Amazon, Netflix, Google, which is now Alphabet, and Tesla, these kinds of companies.
Well, and the price-earnings ratio, Dave, it reminds me back of 1999 when price-earnings ratios, which should have been in the 14 or 15 range, were in the sometimes hundreds of % range for single stocks, but as an average, they got up into the 60, 70, 80 range. And I think these FANGs are up in that range, are they not?
Right. If you just take 5 companies, they represent 1/3 of the move in price from the beginning of the year in the S&P 500. Barron's has been asking a very reasonable question, and it's this: is the collective PE, which is averaging 92.3 of these companies, is it indicative of a bull market, which is long in the tooth?
That means it would take 92 years to break even from the profits or the dividends of the company.
It's not stopping the parade.
Right.
The investors who step in and say, I don't care if it's 92 years or 1,000 years, you don't understand the story. You don't understand the story. And I read more and more about sort of this idea of a market melt-up, which you just can't afford to miss out on.
Right.
And as I recall, market melt-ups last a fraction of the time that the ensuing market meltdown and recovery does. So you look at Japan melting up over a period of months, and it circles ever lower, working off the excessive enthusiasm for the next 20 years. That's a long time to recover value on the basis of your view of a storied company. When others are excessively brave,
right.
And again, this is not necessarily brave for any particular solid reason, but just blindly brave. When others are excessively brave, you should be cautious.
Well, and there's an error in being too optimistic. When you're an investor, probably one of the best ways to measure where you're at as far as the overall attitude of the people is to just look at the volatility index. When the volatility index is low, then at that point, that means that there's an awful lot of artificial comfort built into the system. We're at all-time highs on some of these markets, all-time margin debt on some of these markets, yet the comfort with the market, which a low volatility index would show, it seems to be really in place.
That's right. And I think this matters because, the fear index, is that volatility index is also known. You can think of it as a sort of investor confidence gauge, right? When you slip from those double-digit levels to single digits, the consensus view amongst investors, as indicated by their buying behavior, the view is off the charts bullish. And frankly, it's typically a great contrarian indicator. What would we do in response to the VIX, which is now below 10? The VIX has reached 9.77. I mean, that's...
When was the last time that happened?
2007.
Oh, right before the last crash.
That's right.
Yeah.
No, I mean, when you get to single-digit levels in the VIX, it's not a timing indicator. It doesn't tell you that things are about to crack apart in the next 24 hours. On the other hand, it does give you an indication that everyone in the investment community is all on one side of the boat. And that's not a very good place to be. It doesn't represent stability.
You know, I saw a picture on the news yesterday, Dave, of a pilot who's now been put on suspension. And they showed the picture of where he was for 2.5 hours during the flight. And it was a reclined seat in first class with a blanket over him. He was just sleeping. Now, he was only one of the pilots on board, but that was a clear breach of the rules. Now, what's interesting to me is I picture the average investor like that. They're at 40,000 feet. They're flying at 500 miles an hour, and they've got a blanket over them, and the volatility index is up. They're just pulling that volatility index all the way down to single digits because the stock market's fine. Don't worry that we're at 40,000 feet. Don't worry that we're at 500 miles an hour.
Hush, little baby, don't you cry.
Yeah.
Yeah. What is the nursery rhyme about when the bow breaks?
Yeah.
Well, I mean, the VIX tells us that we may have found sort of the gateway to nirvana. I mean, that's the idea.
Right.
You have central banks who are the modern day alchemists, and they have created this context where you just assume that it's different this time.
Right.
And, you know, who's in line for the easy money? The easy money is looking for the one-way bet because stocks can't go down. They only go up. We know that. That's the nature of central bank alchemy.
Well, and you're not a panic-oriented guy, Dave. You're very calm. I mean, people who've listened to this show for years have heard that you have a healthy dose of skepticism, but you're not a guy that panics. I've been with you in situations where I probably would have panicked, you know, sports types of situations, that type of thing, and you're very level-headed. I certainly wouldn't have gone climbing with my son on the spires that you did, you know, over in Moab. But healthy skepticism, you know, we were talking about that earlier. You know, when you get into the car to put a seatbelt on, it's not that you're panicking. It's that you have a healthy sense of skepticism that you're going to arrive the way you started.
Right. Well, and I don't think there's any reason for us to ever take a tone of fear. Right. Or panic. But I agree, healthy skepticism is what keeps an investor intact through long cycles. Right. And, you know, when you get to periods of excessive valuation, it's pretty easy to second guess and say, well, gosh, I mean, it's gone this far. Maybe it will go further. Yeah.
Well, and maybe it will, Dave.
And maybe it will. And maybe it will. But I think you need to remember this. There is the opposite danger at the other end of the spectrum. Too much pessimism. Yeah. And too little optimism, and that's the birthplace of a long-term bull market.
And we're not there right now.
No, what I'm arguing for is that the sentiment in the market indicates that we have universal enthusiasm, record valuations, and really the birthplace of a bear market. Mm-hmm. But the birthplace of a bear market is not obvious any more than the birthplace of a bull market is obvious, because the tone and tenor, I mean, think about that. You have generational disillusionment at a market low. Nobody wants to touch the asset that they should be buying with both fists. Nobody wants to touch it because it's viewed as toxic, as worthless. The story is dead. The love affair is over, and people are ready to move on, maybe for a generation. Right. And again, we're at the opposite end of the spectrum here. But in both of those ranges, if you will, at the extremes, you have the birth of a new market. And I think that's where we're at.
You know, we were talking about GDP here in America, and a person would say, well, you know, GDP doesn't necessarily have to rise as long as you have an engine of growth somewhere in the world. Now, the last decade especially, China has been that hope. It's been the engine of growth. But we're starting to see some of the commodities that China holds a large amount of, some of these industrial metals, they've been plummeting over the last few weeks.
And the real issue with China is not so much the commodities, but what commodities are attached to. And we're talking about commodity-related credit. Commodity-related credit is like what we had here in the United States in the 2005, 6, and 7 timeframe leading up to the global financial crisis. We had mortgage-backed
Ours was
securities.
real estate.
It was real estate-based credit. And ours is to some degree, because it's the same story, but a different iteration in China, because what's happened is commodity stockpiles stockpiles have been used on a massive scale as collateral for real estate development projects. And it's very interesting, the connection between commodities, the pricing of commodities, the nature of collateral in China, and the growth in the real estate market.
So when you see a drop in those commodity prices, then it may be saying something about another market.
Well, it's very complex because you ordinarily would say the industrial commodities are telling you a story about global growth. Maybe, maybe not. Maybe it's just a story about China. And we already have a slowing down in the Chinese markets. Prices continue to move higher. T.S. Lombard out of London is saying that they would expect a 15 to 20% decline in sales in China, that is in real estate. And the nature of a slowing market is that often a slowing market becomes a seizing market because you've got dynamics on the downside which become self-reinforcing. And we saw that in the 1987 crash, but also in China, I think that's a real possibility.
So when the value of the collateral that's securing the loan goes down beyond a certain point, it becomes a self-fulfilling prophecy that it will go lower.
Right. Now, there's added complexity within the Chinese market because the Chinese government and specifically the People's Bank of China has tried to rein in credit expansion through natural channels, and it's forced credit expansion into the shadows, that is shadow banks, and through what are known as wealth management products. And the wealth management products are sort of these structured products that are supposed to look like money market funds, but give you an 8, 10, 12% quote unquote guaranteed
return.
And
they're gigantic, Dave. We're talking trillions of dollars.
But keep that in mind. How do you have something that is a monetary equivalent, right? A low risk money equivalent that yields 6, 8, 10, 12%. But that's the way it's being sold. And you're right. It's attracted $4 trillion US dollars into those wealth management products. So again, China becomes a market issue right here, right now. We had big declines last week in iron ore and in steel, in the industrial commodities. And it seems to be related to concerns of tightening measures. And again, there's risk problems which then emerge in the wealth management products and within the shadow banking. Not a small issue. $4 trillion is not a small issue. Right. The industrial commodities are implicated in two ways. Number one, you've got oversupply. And that's because you've got above ground stockpiles, which we mentioned have been used as sort of a basis for asset-backed financing.
Right.
And you got the inventory financing, which again, same thing. That's fed into the Chinese real estate bubble. And number two, you've got global demand for those commodities, which is less than ideal. So, I mean, in the final analysis, it's important to keep China in mind.
Right.
Not just because of its growing economic contribution to global GDP. The size of their economy relative to the rest of the world's economies is continuing to inch up. Theirs inching up, ours inching down. And the massive effect, I think this is the other reason you have to remember China, the massive effect it has on commodities and on commodity producing nations.
Right. And what we want to see as a potential enemy someday of China, we want to see peace over there. Because if there's any kind of social disruption or if the slowdown actually affects the pocketbook, they have a substantial military.
Well, that's right. So if their credit bubble moves into a dangerous phase, right, and they're tightening down expectations on insurance companies in recent weeks here. And again, kind of focusing on wealth management products and shadow banking. That's where they're nitpicking right now and trying to tighten credit. But if economic weakness in that country accelerates, you have massive political implications. Right. Within your own borders. I mean, if you're in China. So in the final analysis, political implications in China, it's very difficult to see that not spilling out into the region and beyond that into the world. So I guess one of the big questions that we have is, as the PBOC continues to try to manage $28 trillion in credit, $28 trillion in credit, which is relative to the size of their economy, absolutely mind-boggling. We have to figure out, is China going to be the primary exporter over the next 3 to 5 years of deflation, or are they going to be the exporter of inflation? Because I think they may set the tone for global financial markets and global economic conditions on the basis of what they are exporting.
Well, we've talked before about Dr. Copper, and Dr. Copper has been showing a substantial drop here recently. So whatever that means, I mean, we could still have an inflationary outcome in some areas, but Dr. Copper is signaling deflation, at least right now, isn't it?
Well, and that's the deal. are we talking about the global economy or are we talking about China? Dr. Copper had his worst drop in 19 months. The price of copper has been in decline now for actually several years off of its more recent peaks.
Well, is it a global barometer?
And that's the question. Is this Chinese growth concerns? Yes, those factor in. But the bigger question is it the global barometer for growth? And you at least don't have it as evidence of an increase in construction, an increase in demand, an increase in economic activity on a scale that surpasses above ground stocks and available supplies. So, the other industrial metals are an issue as well. And what we want to try to determine in coming months is whether this slowing trend goes beyond China and a stockpile issue, or whether there's a slowing trend in the emerging markets as well.
Okay, so we talked about the markets being at highs and all the indicators right now showing us 1987, 1999, 2007. And we talked about slowing GDP growth here in America and possibly slowing GDP growth in the other engine of growth, which is China. There's an insurance policy, Dave, for people who are out in the investment world. They call them derivatives. They build these insurance policies. They're all just a little bit different, but they are supposed to secure a portfolio. It's a little like what you're talking about, shorting a market. You're trying to secure a portfolio, but derivatives are a little bit different. There are all these little types of contracts that have strange ties. And in the past, we've talked to people who analyze the market crashes, like in 1987. I'm thinking of Richard Buchstaber, who wrote A Demon of Our Own Design. And he was talking about how derivatives actually became the problem. The insurance product that was supposed to insure the market from volatility and insure the market from crashes actually turned into an accelerator of the crash.
Yeah, and that is the self-reinforcing nature of a decline. And that is what happened in 87, the market crash. Bill King reminded us a number of weeks ago that you had Dan Rostenkowski, head of the House Ways and Means, who was proposing disallowing a deduction on corporate takeovers.
Tax deduction.
Yeah. And then at the same time, Jim Baker, over the weekend, this is preceding the collapse in the stock market, October 19th, he starts slamming Germany for different policy measures. And again, you think, does any of this matter? Well, it ended up triggering something that was sort of a self-cascading or self-reinforcing event.
And it was derivatives, wasn't it?
That was, again, Jim Baker on the 18th. The 19th opens up on a very interesting note. That's October 19th. 1987, your insurance derivatives took over from there.
Right.
And it's interesting that we have roughly today $200 billion in the market that is practicing a very similar dynamic hedge strategy as we saw in 1987, where, again, if volatility increases, you reduce your holdings, that is, you sell stocks.
Right.
And when volatility decreases, going back to the VIX, again, it's shrinking in size.
Right. And the VIX right now, you said, was as low as it's been in 8 years.
It's the lowest level it's been in 8 years. So
Since
what do
the
you
last
do?
crash.
If you're trading volatility, then you're buying more and more stocks as the volatility index gets lower and lower. And there's $200-300 billion trading this kind of a model right now. So yeah, VIX is at its 8-year low. And you can assume that hundreds of billions of dollars of managed money are as fully invested as they have been in the last decade. So you go back to 87, and managing equity exposure based on volatility is precisely what triggered the cascade of selling in 87.
Right, and then volatility starts increasing. At that point, the VIX just skyrockets.
Right, so then you get market selling. Market selling increases volatility, which begets more selling, which increases losses and forces models to sell even more. In the amount of money implicated in the 87 crash, I mean, we're talking about $60 billion on a $3 trillion market cap back then. And now you're talking about hundreds of billions in a space that's now 25, almost $30 trillion. So the numbers are bigger and the percentages are bigger because, again, the 87 crash, the portfolio insurance modeling, that was less than 2% of the total stock market capitalization.
Okay, so what you're talking about, this 2% played a key role back in 1987.
21% downside in one day.
What's the percentage right now?
4 to 5%. Now I'm saying 4 to 5% if you also include, your margin assets as well. So
it sounds small, Dave, but it was 2% in 87.
2% in 87 absolutely bludgeoned the snot out of the market. And there's 4 to 5% that is equally vulnerable, if not more so. Same dynamics in terms of volatility trading. On top of that, a record amount of margin debt, which again is just, there's a sell by date. You have to pay it back at some point. And people generally tend to liquidate positions on margin if it starts to go against them. Either they liquidate it or the house liquidates it for them. Doesn't sound like much, 4 or 5%, until you recall that we have in play risk assets that are equal to 100% more than what's needed to drive equities, 20, 25% lower on a day.
Well, let's look at what's a little bit different this time, Dave, or a lot of bit different, because I was there in 1987. That was my first year here with your family. And that was an amazing year. But back then, people were actually managing their money. You didn't have index funds that I remember. You had people actually buying and selling real stocks.
Right. The dynamic of the market became one of panic where people were selling indiscriminately. Right. But the unique nature in 87 is that's a rare thing to happen because people normally buy and sell
selectively.
That's right. And they weed through what they have.
But an index fund doesn't allow you the selection.
That's the difference, because today, 25% of the market, you're talking $7 trillion, 25% of the market today is in index products, where when you're buying or selling, it is the equivalent of a panic sell where everything goes or everything is bought.
Well, it's like a fruitcake, okay? You cut it. I mean, it's got all these different stocks in it. There could be very good stocks being cut away and sold at that time. Everybody goes, doesn't it? I mean, when you have these index funds, especially, we were talking about Facebook and Amazon and those guys.
I love it.
If you have the slice of fruitcake coming off, okay.
Fruitcake investing for the modern era. Welcome to the world of index funds. It's preferred for those that love fruitcakes or who are. Now, there's the allure of liquidity.
Right.
There's the allure of liquidity, the desire for sector exposure. I need to own some biotech. I need to own this. But the merits of an individual company have been lost. Right. And what it's done is it's concentrated investors into ETFs. And yes, it's very easy to buy. And yes, it's very easy to sell unless, and this is the thing I think most investors don't remember, unless it's not easy to sell.
Right.
We may test this in the not too distant future. A large number of sellers show up at once.
Dave, you've got to have a buyer. If you've got this 25% selling, you need a buyer. Who's going to buy Amazon, Facebook, Netflix,
or the indexes and the composite, all the other stuff that's in there? The market has to have buyers and sellers.
Right.
And when buyers go on strike, it doesn't take very many sellers to drive the market to nothing. Right. Or to near nothing, to see 20, 30, 40, 50, 60, 80% declines. That happens. Now we're talking about $7 trillion in non-discriminating, trend-following allocations via passive vehicles. And who takes the other side of the trade?
Right.
Who takes the other side of the trade on $100 billion? Who takes the other side of the trade on $500 billion? Who takes the other side of the trade on $2 trillion?
Well, yes, but we've got the Federal Reserve, Dave. I mean, of course they're going to just buy everything.
Well, back to the Bank of Japan, back to what we see modeled with the European Central Bank. How do you see a balance sheet go from $4.5 trillion? And I realized the Fed just 2 weeks ago was saying, we'll shrink our $4.5 trillion balance sheet.
Right.
And the market didn't bat an eye. I think the market didn't bat an eye because the market doesn't believe them.
Right.
There's massive ramifications to shrinking the Fed balance sheet, and there's actually good reason to believe that the Fed balance sheet's next significant move, and I say significant, is higher, not lower. Because again, I mean, what we're doing here is we're building in systemic vulnerability by our buying preferences with these autopilot funds, the ETFs. Again, count it all together. You've got $500 billion in borrowed money, margin money, highest amount relative to stock market capitalization, relative to GDP in history.
Right.
Then you've got $200 to $400 billion in volatility sensitive, professionally managed assets, which trades exactly like the portfolio insurance models of 1987, right? So selling begets selling begets selling. And that is what your safety is based on, is getting out of the way of the market.
And you have the fear or comfort index at a low that we haven't seen since before the last crash.
And then we're pretending that we have normal liquidity.
Right.
And hypothetically, we do. But is there such thing as an abnormal day where there's more sellers than buyers? Because the market structure today doesn't support it. The market structure and the way we're building index funds and exposure, it's actually not necessarily panic that will show up in the market. It's just a blind liquidation, which is virtually the same thing when it comes to sorting out the trades.
Well, and there are things that can happen that we've never seen before or haven't seen in over 100 years. A couple of weeks ago, we were talking about World War I. When the assassination occurred in Sarajevo, which we all look back and say, okay, that was the beginning of World War I. It really wasn't. That was June 28th, 1914, and everything just tooled along. The stock market was just fine, very little reaction when that occurred. And then 1 month later, July 28th, 1914, it was announced that war had been declared, and they just shut the stock market down for 4 months, Dave. The stock started falling. There were no buyers. This is going to what you're talking about. When there's no buyers, what do? Well, you just, it reminds me of the end of the movie Rollover, that Chris Christopherson movie, where they just covered up all the screens.
Jane Fonda?
Yeah.
This is a family classic, as a matter of fact. If you haven't seen it, you need to see it.
But it was based on the market just crumbled, and so They just covered everything up and shut it down.
Well, I mean, to some degree, I think people are willfully blind to what they don't want to see.
Right.
We know that that's true in human psychology. The things that we don't want to see about ourselves, we ignore. We cover over. I mean, it's we have the equivalent of makeup, which we put on subconsciously. And I think investors have certain beliefs that they want to maintain. And maybe that is about the style of their retirement, or again, the allure of some particular thing in the future.
Right.
And you can ignore certain things, which I think are very pertinent. So since the 08-09 global financial crisis, consumer credit has grown considerably.
Right.
And the areas where it's grown the most, of course, we've talked about student loans before, it's also grown considerably in the auto sector. And seeing auto weakness here, the fourth month in a row, is significant. 4 months down in terms of sales and growth and inventories, and now you're having banks who are starting to pull back from the auto loan business. And when you look at used cars, prices have begun to plummet. And again, this was a huge source of growth in the consumer lending space. And this is a key point to linger on, because consumer credit growth, again, post 08-09, autos were a primary feature. As the cycle gets further and further along, what have we seen? The trend is, if you're going to keep the trend in place and keep the momentum going, you have to find enough bodies to keep momentum going.
Right.
So you lower your standards in terms of who qualifies for a loan. You extend the terms to make the payments cheaper and maybe extend it out even to 70 months or what have you. But right now, banks are starting to take losses, and they're on a significant size enough loan book that they say, we have to be careful here. It's interesting. It's kind of then and only then do bankers change behavior. They always have skin in the game, but very rarely do they lose skin. When they do, it's like, oh, wait, let's be cautious here.
Well, and there's a pressure on bankers, just like there's a pressure on, say, hedge fund managers. When everybody's doing something and you're not, and they're making money and you're not, well, they're going to lose their job. And so what I've found through the years, Dave, it's amazing. We can predict these crashes up to a point. We can't predict exactly when they'll happen, but when the numbers line up, we can start warning people and say, well, look, when the PE gets this high, when the margin debt gets this high, there's going to be a crash. But what's amazing after it happens and everybody loses, that's what everybody says. They say, oh, well, but everybody lost. When you talk to somebody, say, oh, yeah, it was 2008. Everybody lost. That's not true. But there is a consolation in just saying that everybody lost.
That's Keynes. Keynes, many, many years ago, said a sound banker, alas, is not one who foresees danger and avoids it, but one who, when he is ruined in a conventional and orthodox way, along with his fellows, so that no one can really blame him.
It's just part of the crowd.
Right.
Even though the warning signs were there.
Well, and we've talked about sort of trends that are self-reinforcing. Bull market trends are self-reinforcing. Bear market trends are self-reinforcing. And I don't know if that's close enough to swarm theory, which we've talked about in the past, but you just see it moves and it moves and it moves, and then all of a sudden it shifts and everything shifts.
Well, okay, so when we've gone diving before and we see a school of fish, thousands and thousands of little fish, they can go one direction, they can swirl, and then all of a sudden there's a predator, and they go, poof, at the same time. Well, it's because they're making the decision based on each other's reaction. And this is very similar to what you're talking about, this exit with index funds.
I don't know how the market accommodates 25% of all stock market capitalization being tied up in what is the equivalent of a mass swarm. Well, I don't know what liquidations look like. And we've really, I think, done ourselves a disservice in creating efficiencies and lowering our cost for money management and things of this nature. We've actually underscored a primary weakness within the market. You assume you can sell. Good luck with that.
Well, and let me ask you a question. Like a Larry Fink, who manages between $4 and $5 trillion. And
he's a part of that theme. I mean, a part of the reason why he manages nearly $5 trillion is because he owns iShares, and iShares is a big index fund company. So
even he's scratching his chin right now and saying, I'm a little concerned about the auto industry now.
Right. But I mean, he would say that's a front edge to an economic decline. It's a leading indicator. And yes, he has concerns about the economy. And that's something that he's been very vocal about. But how do we react?
Well, yeah, okay. Vehicles have gone up pretty dramatically in my adult life. Okay. To go buy a car or an SUV right now, you're talking $40,000, $45,000, $50,000, $55,000. The profits in that vehicle, they're just minuscule at this point, are they not?
It's interesting. I mean, better to be the dealer and sort of self-finance your inventory than to be the manufacturer, because GM makes an average of $1,400, $1,418 average per vehicle.
On probably profit. What? Average being $40,000 vehicle?
Yeah. Ford makes $1,174. And again, this is where swarm theory, everyone loves the idea of our modern day Nifty 50, and one of those being Tesla. Throw Tesla in the mix. A very popular theme. It's going to change the world. It's clean energy. It's everything. Everything positive, including mom's apple pie.
Well, how much money does Tesla make when they sell one of their vehicles?
They lose $15,855 average vehicle.
Yeah, but they make it up on volume. And it's electric.
This is the nature of publicly traded markets. There's somebody who's a patsy every day in every generation. And maybe in the fullness of time, Tesla wipes out GM and Ford and everyone else. But between here and there, you've got some serious vulnerability. The only way they stay alive is to raise new capital. They are burning through investor capital like nobody's business. Why? Oh, because they lose an average of $15,855 per vehicle sold. That's not a way of doing business. And yet we have this opinion. Again, imagine the swarm. This is a company who's being judged on the basis of its market cap and the trend for its share price, not on the basis of revenues, not on the basis of sales, not on the basis of profits. Which one of these is not like the other? GM's making money. Ford's making money. Tesla's not making money, but man, have they got a great story. And so the swarm does what it does. Everything shifts, and it doesn't matter if you make a little or a lot. The swarm has moved. When the swarm moves back and shifts a different direction, quite frankly, I'm afraid that there's frailties within the financial system today that are going to shock and amaze investors. They thought they were saving a few bucks buying an index fund. Little did they know that they participated in retrospect. I think this will be sort of the way the story is written. We understand the dynamics of 1987. We're setting those same dynamics in motion today, and actually index funds play a part.
Over the last year, Dave, we've been talking to people about the 65-week moving average on gold. Now, gold has had some increase this year, and that was what we would call an A wave increase, okay? A, B, C, D wave, A being up. We've discussed this in the past. A B wave correction, which is always expected. Then a C wave usually takes you to higher highs, and then a D wave correction. And we've been in this A wave for the last couple of months, and it seems that we're having a B wave correction. Yet, the longer moving average, which usually tells the trend, the 65-week moving average, has continued to just plot higher and higher. So I wanted to bring that up because people are saying, hey, what's happening to gold right now? Well, part of it's predictable.
And part of it is inconsequential. I mean, I had this conversation this last week with Sean from the SGT report. And, for our listeners who don't know what that is, sgdreport.com has a very large web presence and YouTube channel. And what we were talking about is sort of economic uncertainty, unrest, and we brought up cryptocurrencies. I think he has an audience that's keen on knowing what are alternatives to the system.
So Bitcoin, that type of thing.
Yeah, and I continually look at the system dependencies that cryptocurrencies have and think that ultimately gold and silver, cryptocurrencies are like like the digital version of gold and silver. The problem with the digital version is it's still system dependent.
Right.
And those are difficult dependencies to work around.
When the power's off, whether it's EMP or just the light switch, you don't get it.
You don't have anything.
Yeah.
But we were also talking about sort of the dangerously high levels in the U.S. stock market and bond market, et cetera. And I think his audience and ours are less sensitive to price movements in the metal, seeing it more as opportunity to add to ounces as opposed to, oh my gosh, what's happening? It's down $20, or it's down $5, or it's down $50, or it's up $3. The short-term moves aren't particularly relevant to an audience that is concerned about maintaining value, maintaining purchasing power, having real money, and having something that is outside of the system and not subject to a kill switch.
Right.
That I think is important. Gold and silver are outside of the system. Cryptocurrencies are outside of the system. Gold and silver are not subject to a kill switch. Cryptocurrencies are.
So A wave, B wave, C, D, none of that really matters in the long run because you're talking about preservation of an asset.
I mean, I understand from establishing cost basis, it's more advantageous to establish a cost basis at 1,200 than it is 1,400. But I mean, we're talking about a small difference in price relative to not only where we've been, but also to where we're going. Over the next 3 to 5 years, do we expect gold to be in the $3,000, $4,000, $5,000 range? We do. And we can map that out, show you why from a technical basis, from a fundamental basis. But honestly, it has less to do, and this is the big point. We're seeing these gyrations in price, and it's like a short-term popularity contest out on the playground. Who's popular at this recess?
Right.
Who's popular at the next recess? Does it really matter? Does it really matter? I mean, if you looked back at sort of the playground conflicts of yesteryear and said, who was actually successful in life?
Yeah.
Did it tie to who was most popular for 5 minutes on the playground when you were 8 years old, 10 years old? I don't think so.
Right.
I'm not trying to win a popularity contest, and I don't think the gold and silver owner are. We like real things, and we know that through time, real things are worth owning.
Well, something that's hit me over and over through the years is there's no generation in the history of man, that if a person owned gold, they would have gone broke. It's hard to say that about most assets, but gold, no one ever goes broke owning an ounce of gold.
It's equally fair to say very few people have gotten rich owning gold. It does what it does, and there's opportunities to use gold as a currency to buy real assets, and I think that's where riches are made, is in the transference of value between cash, or your best cash equivalent, in my opinion, gold and silver ounces, for real assets. Okay. And that's a value exchange I can be patient waiting for. I think our investors can too. And it was interesting. I had a great rapport with Sean. My sense was that his listeners were in that same category of volatility, one day to the next, 1 week to the next. This is not what we sweat. What we worry about are the system frailties that exist. Some of them by design, some of them by accident, some of them by investor preference, where people think they know what they want until they get what they want and are disappointed.
Well, I really liked the interview. I think we should post it on this site this week so that people can listen to it. Even though it's a different service, it was a great interview.
Yeah, we'll post a link to the interview on our website, McAlvanyWeeklyCommentary.com. And for our YouTube listeners, they can find a link to the interview in the description below the video.
Thank you for listening to the McAlvany Weekly Commentary today. We'll see you next Wednesday, and be sure to follow us on Twitter at ICA Gold. You can also follow David at David McAlvany. And if you'd like to learn more about us and what we do, visit us online at McAlvany.com. That's spelled McAlvany.com. Or you can give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.